In today's video, we're going to talk about the 10 biggest financial mistakes high-income earners make and how to avoid them. If you're earning a six-figure salary or more, you might think you're on the fast track to wealth, but that's not always the case. Many high-income earners fall into common traps that prevent them from building and growing their wealth over time. These mistakes can cost you thousands or even millions of dollars in lost opportunities, taxes, fees, and interest. So if you want to learn how to make the most of your money and reach your financial goals faster, make sure you watch this video till the end. And don't forget to hit the like button and subscribe to our channel for more videos like this. Mistake number 1. Having a low savings rate. This means they spend too much of their income and save too little. According to a report by CNBC, Americans save between 3% and 10% of their paychecks, on average. That's not enough to build wealth, especially if you have a high income. You see, wealth is not measured by how much you earn, but by how much you keep. A person who earns $50,000 per year and saves $10,000 of it builds wealth faster than the person who earns $1 million per year and spends every penny. That's because the more you save and invest, the more your money grows on its own, thanks to the power of compounding. Compounding is when your money earns interest or returns, and then that interest or returns earn more interest or returns, and so on. Over time, this can turn a small amount of money into a large fortune. For example, let's say you earn $100,000 per year and save 10% of it, or $10,000 per year. If you invest that money in a diversified portfolio that earns an average annual return of 8%, after 30 years, you'll have about $1.2 million. Not bad, right? But what if you save 20% of your income instead, or $20,000 per year? In that case, after 30 years, you'll have about $2.4 million. That's twice as much as before. And what if you save 30% of your income, or $30,000 per year? Then you'll have about $3.6 million after 30 years. That's 3 times as much as before. As you can see, increasing your savings rate can make a huge difference in your wealth over time. So how can you increase your savings rate? Well, there are 2 ways. Either earn more or spend less. Ideally, you should do both. To earn more, you can ask for a raise, negotiate a higher salary, start a side hustle, create passive income streams, or invest in yourself by learning new skills or getting a higher education. To spend less, you can create a budget and stick to it. Track your expenses and cut unnecessary ones, use coupons and discounts, avoid lifestyle inflation, or adopt a minimalist mindset. The key is to find a balance between enjoying your life now and saving for your future. Speaking of saving for your future, that brings us to the second mistake. Mistake number 2, failing to stick to a budget. A budget is a plan that shows how much money you expect to earn and spend in a given period of time. It helps you control your cash flow and allocate your money to your needs and wants. Without a budget, you might overspend on things that don't matter and underspend on things that do matter. You might also miss important payments or savings goals. For example, let's say you earn $10,000 per month after taxes and have the following expenses: rent, $3,000, utilities, $500, groceries, $800, dining out, $600, entertainment, $400, transportation, $300, clothing, $200, insurance, $200, debt payments, $500, savings, $1,000. Your total expenses are $7,500 per month, which means you have $2,500 left over. That's great, right? You can use that money to save more, invest more, or treat yourself more. But what if you don't have a budget and you don't track your spending? You might end up spending more than you think on things like dining out, entertainment, or clothing. Maybe you go out with your friends every weekend and spend $200 each time. Maybe you buy a new gadget or a new outfit every month and spend $300 each time. Maybe you subscribe to multiple streaming services and spend $100 each time. Before you know it, you've spent $2,000 more than you planned, and you only have $500 left over. That's not so great, right? You've just wasted money that could have gone to your savings, investments, or debt payments. So how can you stick to a budget? Well, there are many tools and apps that can help you create and track your budget, such as Mint.com, Personal Capital, or YNAB. You can also use a simple spreadsheet or a pen and paper. The important thing is to make your budget realistic and flexible. Don't make it too strict or too loose. Allow yourself some room for fun and unexpected expenses, but also set some limits and boundaries. And review your budget regularly and adjust it as needed. Another thing you need to adjust as needed is your emergency fund, which leads us to the third mistake. Mistake number 3, not having an emergency fund. An emergency fund is a stash of money that you set aside for unexpected events that can disrupt your income or increase your expenses, such as losing your job, getting sick or injured, having a car breakdown, or needing a home repair. Having an emergency fund can help you avoid going into debt, dipping into your retirement savings, or selling your investments at a loss when an emergency strikes. For example, let's say you earn $150,000 per year and have no emergency fund. One day, you get laid off from your job due to a recession. You have no income coming in, but you still have bills to pay. You have some savings in your 401k and IRA accounts, but if you withdraw from them before age 59 and a half, you'll have to pay taxes and penalties. You also have some investments in the stock market, but the market is down due to the recession. If you sell them now, you'll lock in your losses. Your only option is to use your credit cards or take out a personal loan to cover your expenses until you find a new job. But that means you'll have to pay high interest rates and fees, which will eat into your future wealth. So how can you build an emergency fund? Well, the general rule of thumb is to have 3 to 6 months worth of living expenses in a separate savings account that's easily accessible and safe from market fluctuations. For example, if your monthly expenses are $5,000, you should aim to have $15,000 to $30,000 in your emergency fund. To build your emergency fund faster, you can save any windfalls such as bonuses, tax refunds, or gifts. You can also cut back on some discretionary spending such as dining out, entertainment, or clothing. And you can look for ways to earn extra income such as doing freelance work, selling stuff online, or taking surveys. Once you have an emergency fund in place, you can focus on growing your wealth through investing. Which brings us to the 4th mistake. Mistake number 4, taking unnecessary risks. Investing is all about balancing risk and reward. The higher the potential reward of an investment, the higher the risk of losing money. The lower the potential reward of an investment, the lower the risk of losing money. As a high-income earner, you might be tempted to chase high returns by investing in risky assets such as penny stocks, cryptocurrencies, or meme stocks. These are assets that have low prices but high volatility and speculation. They can skyrocket in value in a short period of time, but they can also plummet in value just as quickly. For example, let's say you invest $1,000 in Dogecoin, a cryptocurrency that started as a joke but became popular due to social media hype and celebrity endorsements. In January 2023, one Dogecoin was worth less than a cent. By May 2023, it reached an all-time high of almost 74 cents. That means if you bought $10,000 worth of Dogecoin in January 2023 and sold it in May 2023, you would have made a profit of $740,000. That's a whopping 7,400% return in just 4 months. Sounds amazing, right? But what if you didn't sell in May 2023 and held on to your Dogecoin? By June 2023, it dropped to 21 cents. That means your $10,000 investment would have shrunk to $28,000. That's a loss of $712,000 in just 1 month. Ouch! So how can you avoid taking unnecessary risks with your investments? Well, the best way is to diversify your portfolio across different asset classes, such as stocks, bonds, real estate, commodities, and cash. Diversification reduces your overall risk by spreading your money among different investments that have different levels of risk and return. That way, if one investment performs poorly, it won't drag down your entire portfolio. You can also use index funds or exchange-traded funds to invest in a broad basket of securities that track a specific market or sector. Index funds and ETFs are low-cost, tax-efficient, and easy to buy and sell. Another thing you need to consider when investing is the tax implications, which brings us to the 5th mistake. Mistake number 5, ignoring taxes. Taxes are one of the biggest expenses you'll face in your lifetime. As a high-income earner, you're likely in a higher tax bracket than most people, which means you pay more taxes on your income. You also pay taxes on your investments, such as capital gains taxes when you sell an asset for a profit or dividend taxes when you receive a payment from a company. Ignoring taxes can significantly reduce your net worth and slow down your wealth creation. For example, let's say you earn $200,000 per year and live in California. According to the Tax Foundation, your federal income tax rate is 32%, your state income tax rate is 9.3%, and your payroll tax rate is 7.65%. That means you pay a total of 48.95% in taxes on your income. That leaves you with $102,100 after taxes. But that's not all. ULs invest $50,000 per year in the stock market and earn an average annual return of 10%. After 1 year, your investment grows to $55,000. If you sell it now, you'll have to pay capital gains taxes on your profit of $5,000. Assuming you're in the same tax bracket as before, your federal capital gains tax rate is 15%. Your state capital gains tax rate is 9.3%, and your net investment income tax rate is 3.8%. That means you pay a total of 28.1% in taxes on your capital gains. That leaves you with $3,595 after taxes. So how can you minimize your taxes? Well, there are many strategies and tools that can help you reduce your tax burden legally and ethically, such as taking advantage of tax deductions and credits that lower your taxable income or tax liability, contributing to tax-advantaged accounts such as 401(k), IRA, HSA, or 529 plan that defer or eliminate taxes on your savings or investments. Holding your investments for at least 1 year to qualify for lower long-term capital gains tax rates. Harvesting your losses by selling underperforming assets to offset your gains. Donating to charity or gifting to family members to reduce your estate or inheritance taxes. Of course, these are just some of the ways you can save on taxes. For more personalized advice, you should consult a qualified tax professional who can help you plan and optimize your tax situation. Another professional you might want to consult is a financial advisor. Which leads us to the 6th mistake. Mistake number 6, hiring the wrong financial advisor. A financial advisor is someone who helps you manage your money and achieve your financial goals. They can provide services such as financial planning, investment management, retirement planning, estate planning, insurance planning, or tax planning. Hiring a financial advisor can be beneficial if you don't have the time, knowledge, or interest to handle your finances on your own. However, not all financial advisors are created equal. Some might be more qualified, experienced, or trustworthy than others. Some might have conflicts of interest or hidden fees that can harm your financial well-being. For example, let's say you hire a financial advisor who charges you a 1% annual fee on your assets under management. That means if you have $1 million in your portfolio, you'll pay $1,000 per year to your advisor. That might not seem like a lot, but over time, it can add up. If your portfolio grows at an average annual rate of 8%, after 30 years, you'll have about $10 million. But if you subtract the fees you paid to your advisor, you'll have about $7.6 million. That's a difference of $2.4 million. That's how much money you lost by hiring that advisor. And that's not even considering the possibility that your advisor might underperform the market, recommend unsuitable investments, or act unethically. So how can you hire the right financial advisor? Well, there are several factors and questions you should consider before hiring an advisor, such as, what are their credentials and qualifications? Look for advisors who have reputable certifications such as CFP, CFA, CPA, or CHFC. How are they compensated? Look for advisors who charge a flat fee or an hourly rate rather than a percentage of your assets or a commission based on the products they sell. What is their investment philosophy and strategy? Look for advisors who follow a passive index-based or evidence-based approach rather than an active stock-picking or market timing approach. How do they communicate and report to you? Look for advisors who are transparent, responsive, and proactive in keeping you informed and updated on your financial situation and progress. What is their fiduciary status? Look for advisors who are legally obligated to act in your best interest rather than their own or their employers. Another thing you should act in your best interest is your debt. Which brings us to the 7th mistake. Mistake number 7, carrying too much debt. Debt is money that you borrow from someone else and have to pay back with interest. Debt can be useful if you use it to buy things that increase in value over time, such as a home, a business, or an education. However, debt can also be harmful if you use it to buy things that decrease in value over time, such as a car, a vacation, or a gadget. Carrying too much debt can limit your cash flow, increase your interest payments, lower your credit score, and jeopardize your financial security. For example, let's say you earn $250,000 per year and have the following debts. Mortgage, $500,000 at 4% interest rate car loan, $50,000 at 6% interest rate student loan, $100,000 at 5% interest rate credit card, $10,000 at 20% interest rate. Your total debt is $660,000 and your monthly debt payments are $4,300. That means you spend 20% of your income on debt payments. That's not too bad, right? You can still afford to live comfortably and save some money. But what if something unexpected happens? What if you lose your job, get sick or injured, or face a lawsuit? What if the interest rates go up or the housing market crashes? What if you want to retire early or start a family? How will you cope with your debt then? So how can you reduce your debt? Well, there are several steps and strategies you can take to pay off your debt faster and easier, such as making a list of all your debts and ranking them by interest rate or balance, paying more than the minimum payment on your debts each month, focusing on paying off one debt at a time while making the minimum payments on the rest, using the debt avalanche method where you pay off the debt with the highest interest rate first, or using the debt snowball method where you pay off the debt with the lowest balance first, refinancing or consolidating your debts to get a lower interest rate or a simpler payment plan, negotiating with your creditors to lower your interest rate or waive some fees, using any windfalls such as bonuses, tax refunds, or gifts to pay off some of your debts. Once you're free from debt, you can focus on building wealth for your future, which brings us to the 8th mistake. Mistake number 8, not planning for retirement. Retirement is the stage of life when you stop working and live off your savings and investments. Retirement can be a wonderful time to enjoy your hobbies, travel the world, or spend time with your loved ones. However, retirement can also be a challenging time if you don't have enough money to support your lifestyle and cover your expenses. As a high-income earner, you might think you don't need to worry about retirement because you have a lot of money. But that's not true. You still need to plan for retirement because you might live longer than you expect. According to the Social Security Administration, the average life expectancy for a 65-year-old in 2023 is 84.6 years for men and 86.9 years for women. That means you might need to fund your retirement for 20 years or more. You might face higher inflation and healthcare costs. Inflation is the increase in the prices of goods and services over time. Healthcare costs are the expenses related to your medical needs and insurance. Both inflation and healthcare costs tend to rise faster than the general economy and can erode your purchasing power and savings. You might have a lower income replacement ratio. The income replacement ratio is the percentage of your pre-retirement income that you need to maintain your standard of living in retirement. For example, if you earn $100,000 per year before retirement and need $80,000 per year after retirement, your income replacement ratio is 80%. As a high-income earner, you might have a lower income replacement ratio than most people because you pay more taxes, save more, and spend less proportionally. For example, let's say you earn $300,000 per year and plan to retire at age 65. You estimate that you'll need 60% of your pre-retirement income to live comfortably in retirement, or $180,000 per year. You also assume that inflation will average 3% per year and that your investments will earn an average annual return of 8%. How much money do you need to save for retirement? Well, using a retirement calculator, you'll find out that you need about $4.5 million in savings by age 65. That's a lot of money. How much do you need to save each month to reach that goal? Well, assuming you start saving at age 25 and increase your savings by 3% each year, you'll need to save about $3,800 per month. That's about 15% of your income. That's not too bad, right? But what if you start saving later or save less? Then you'll need to save more or work longer. So how can you plan for retirement? Well, there are several steps and tips you can follow to prepare for your golden years, such as setting a retirement goal based on your desired lifestyle, expenses, and income sources, saving as much as possible as early as possible and increasing your savings rate over time, investing wisely and diversifying your portfolio across different asset classes and accounts, taking advantage of tax-advantaged accounts such as 401(k), IRA, Roth IRA, or HSA. Maximizing your employer match if you have one. Reducing your fees and expenses by choosing low-cost index funds or ETFs. Reviewing your portfolio regularly and rebalancing it as needed. Planning for Social Security and Medicare benefits. Creating a withdrawal strategy that minimizes taxes and maximizes longevity. Another thing you need to create is a will, which leads us to the 9th mistake. Mistake number 9, not having a will. A will is a legal document that specifies how you want your assets and affairs to be handled after your death. It allows you to name beneficiaries who will inherit your property, appoint guardians who will take care of your minor children, designate executors who will carry out your wishes, and express any other preferences or instructions that are important to you. Having a will can ensure that your legacy is preserved and that your loved ones are protected. For example, let's say you die without a will. What happens then? Well, depending on where you live, the state law will determine how your estate is distributed according to a set of rules called intestacy laws. These laws vary by state but generally follow a hierarchy of relatives based on their degree of kinship to you. For example, in most states, if you're married and have children, your spouse will get half of your estate and your children will get the other half. If you're not married but have children, your children will get everything. If you have no spouse or children but have parents or siblings, they will get everything. And so on. But what if these laws don't reflect your wishes? What if you want to leave some of your assets to someone who is not related to you by blood or marriage? What if you want to disinherit someone who is related to you by blood or marriage? What if you have a blended family or a complex family situation? What if you have specific instructions for your funeral or burial? What if you have pets or charities that you want to support? Without a will, you won't have any say in these matters. Your estate will be subject to the state law, which might not be in your best interest or your loved one's best interest. So how can you make a will? Well, there are several options and resources you can use to create a will, such as hiring an attorney who specializes in estate planning and can draft a customized and valid will for you. Using an online service or software that can help you create a simple and standard will for a low cost. Writing your own will by hand or using a template that follows the legal requirements of your state. Whichever option you choose, make sure you sign and date your will in front of 2 witnesses who are not beneficiaries of your will. You should also store your will in a safe and accessible place and update it whenever there are major changes in your life or circumstances. One of the major changes that might affect your will is getting married or divorced, which brings us to the 10th and final mistake. Mistake number 10, not protecting your assets in case of divorce. Divorce is the legal dissolution of a marriage. It can be a painful and stressful process that can have a negative impact on your emotional, physical, and financial well-being. As a high-income earner, you might have more assets at stake than the average person, such as your home, your business, your investments, your retirement accounts, or your inheritance. If you don't protect these assets in case of divorce, you might lose half or more of them to your ex-spouse. For example, let's say you're married and have a net worth of $10 million. You earned most of this money before and during your marriage through your successful career as a software engineer. You also inherited some of it from your parents. You love your spouse and trust them completely. You don't think you'll ever get divorced. But one day, things change. You and your spouse grow apart. You have irreconcilable differences. You decide to end your marriage. You file for divorce. What happens then? Well, depending on where you live, the divorce law will determine how your assets are divided between you and your ex-spouse according to one of 2 systems: community property or equitable distribution. These systems vary by state but generally follow these principles. Community property states treat all assets acquired during the marriage as equally owned by both spouses, regardless of who earned them or whose name is on them. Equitable distribution states treat all assets acquired during the marriage as subject to fair and reasonable division by the court based on various factors such as the length of the marriage, the income and earning potential of each spouse, the contribution of each spouse to the marital property, and the needs and circumstances of each spouse. But what if these systems don't reflect your wishes? What if you want to keep all or most of the assets that you earned or inherited? What if you want to avoid a lengthy and costly legal battle with your ex-spouse? What if you want to preserve your wealth for yourself or your children, without protecting your assets in case of divorce? You won't have any guarantee that these wishes will be fulfilled. Your assets will be subject to the divorce law, which might not be in your favor or your ex-spouse's favor. So how can you protect your assets in case of divorce? Well, there are several steps and strategies you can take to safeguard your wealth from a potential split, such as signing a prenuptial agreement before getting married that specifies how your assets will be divided in case of divorce. Signing a postnuptial agreement after getting married that modifies or replaces the prenuptial agreement. Keeping separate accounts for your income and expenses that are not commingled with your spouse's accounts. Keeping separate records and receipts for any assets that are not marital property such as gifts or inheritances. Transferring some of your assets to a trust that is not subject to marital claims. Seeking professional advice from an attorney or a financial planner who can help you plan and protect your assets.